Most companies have actually said that they believe what we did yesterday was exactly the right thing to do, and that they feel that it has an incentive because it is for 6 months before their production comes online, and because we're going to spend the next couple of years replenishing the reserve. That means that they are incentivized to continue to spend the capex that they've announced to increase production.
Amos Hochstein there of the Biden administration joining us a few hours ago on the crude situation. AMH joins us now down in DC. Anne-Marie, a lot of pushback to this. Amos saying that some people in the oil patch are happy with it. Some really strong words from the president yesterday, and I'll run through them again and share them with our audience. Companies have an obligation that goes beyond just the shareholders, their customers, their communities, their country. No American company should take advantage of a pandemic or Putin to enrich themselves at the expense of American families. Anne-Marie, that's some strong stuff.
It is strong, and I think, Jonathan, there's really 2 points to make here. One is that it's a complete 180 for this administration, a third drawdown from the SPR. This was a president who campaigned to make climate a pivotal sector of his entire campaign and wanted it to be part of his presidency. And in the second half, you do have a war that is going on, and obviously Russia is such a massive commodity producer, especially in the oil and gas world, and that is adding a premium to the price. And the issue this administration has is it's just a too short of many months, Jonathan, until we get to November. And those gasoline prices are going to hit hard. Consumers at the pump, but also what Amos said in that interview is it's not just farm to table, it's farm to truck to table. The oil prices increases everything along the supply chain, and that is just hurting consumers.
One conversation we had, Anne-Marie, and I'd love your views on this talking point of the administration, and it is that, a talking point of the amount of leases that some of these oil companies are sitting on. The way it's framed often is as if they're sitting on this really productive land with this very, very cheap oil that they can just get hold of and sell into the market. It's really not that simple at all. Why do they keep bringing this up?
Well, it's not simple, right? And Amos was fair about that. He said that not all the time you're going to have a very productive well, and you have to do a lot of digging, geology, seismic testing to make sure there actually is profitable oil in these wells to use them. On the other side, the administration thinks that if you're just holding on to these leases and you're not using them, then you should have to pay a fee. Why should you just sit on them? Either use it or lose it. And potentially, Jonathan, this might actually get some steam in Congress, and that's what the president was calling on yesterday. But it is a talking point for the administration because 9,000 sounds like a lot. The issue is, until you find out exactly how much oil are in those wells, it's going to be much less.
Anne-Marie, thank you. AMH, it's a nuanced debate, and I look to add a little bit more value to it, and I know you do too, and the administration in the coming weeks, months, and let's hope it's not years we're talking about this. Some breaking data just crossing the wires. Mike McKee breaking through all of it down in DC. Mike, put it together for us.
Awful lot of news, John. We've been talking about the fact that March was the month when the war started, and we're seeing some results in the United States. Better manufacturing news from the S&P Global, which used to be the market, ISM numbers, PMI numbers, 58.8. Now that's the final number. The preliminary was 58.5, so it went up at the end of the month. Not the same in Europe. You can see there that the PMIs there went down across the board as the month went on and as the war started raging. Then the big problem for the Europeans is inflation. The European CPI comes in at 7.5%. That is the highest ever, basically, for the Eurozone, and it's something they're going to have to really work on. The ECB's got a tough job ahead of it. And before I let you go, John, one more thing to note. That's the Chinese PMI. The Caixin came in below 50, joined the state PMIs below 50, suggests some contraction in the Chinese economy. Not good for the overall global economy.
Mike McKee, I'm pleased you gave us the global view. Thank you, sir, because I want to get to Mike Collins on this. Mike Collins, 7.5% CPI in the Eurozone, a deposit rate at negative 50 basis points. They're going to be doing QE through to Q3 if their guidance is anything to go by. What changes for you in Europe?
You know, their GDP and their growth is slowing more quickly than ours, Jonathan, right? So I think the ECB has already kind of tipped their hand and indicated that they're going to focus probably a little more on the growth side of the equation than the inflation side. And I wouldn't be surprised if the Fed's in the same boat, right? At the end of the year, if inflation is still running at 7, but growth is tilting down toward 1, what does the Fed do in that world? I actually think that they probably start focusing a little more on the growth story and provide wide support. But for right now, I mean, they are singularly focused on inflation, and they're going to run hot, and they're going to keep hiking, right? I think there's a chance they do 100 basis point, hike in May and June. Why stop at 50, right? If you stop at 50, Jonathan, in May and June, by the end of July, when your third meeting comes up, you're averaging like a half a point of Fed funds rate for almost 4 months. Between now and then, why not get there sooner?
Mike Collins, you don't get to say that and walk away. I've got 60 seconds left. You think they should go more than 50? Now, is that a should call or a will call? You think they will, or you think they should?
They could. I mean, their next meeting, May 4th, is a long time away, Jonathan. They have plenty of time to set up the markets for a more aggressive hike. Like I said, their third meeting this year from now is not for 4 months, right? So if they're doing 50 and 50, they're sitting here at 0.5% funds rate on average through most of the summer, right? And is that really where they want to be? You saw Jeff Rosenberg this morning say, yeah, the Fed wants to get ahead of this. That is not getting ahead of it, right? I mean, we're really short the front of the curve. So, I'm talking my book to some extent, but I think they're going to ratchet up the funds rate really aggressively here, and the curve's probably going to keep inverting.
Well, at least you're open about talking your book. I appreciate that. Mike Collins. And a special thanks to Anastasia Amoroso, to you both. I appreciate it. Thank you. A really solid jobs report behind us in the United States, and off the back of that, yields higher materially by 11 basis points on a 2-year at the moment to 244, on a 10-year also at 244, up by around about 10 basis points. Joining us now on Bloomberg TV and on Bloomberg Radio, U.S. Labor Secretary Marty Walsh. Secretary Walsh, what a jobs report. Just fantastic. Most people have come on the program this morning with Tom and myself and Lisa on Bloomberg Surveillance and on the Open have all said it looks great. What are you most enthused by looking at this?
Well, I think one of the things that I like is we saw an increase in labor participation rate. So one thing we spoke about this morning, a good, unemployment number low, a good strong report, good last 3 months report, actually a good last 11-month report, over 450,000 jobs. And we think about moving forward into 2022, 1.6 million people still need to return back to the workforce. How do we get those folks back to work? How do we make sure that labor participation number goes up? Certainly there's still jobs open in the United States. That's one of the things. I'm not taking away from the report. I'm very excited about the report, but I think we're thinking about here, how do we move forward? The second thing is we're also looking at, what can be done by Congress. We have the Bipartisan Innovation Act, other known as the CHIPS bill. That allows us opportunity for supply chain issues moving forward. We have some COVID relief money still being talked about at Upper Capitol Hill. They need to pass that because we're watching, I'm seeing what's going on in China and parts of Europe with another variant going up. We want to make sure that we're prepared for that here in the United States. And then obviously inflation. We're working the president is very laser focused on bringing the cost down. Lots of challenges there. You were just talking about global challenges there that we have in other markets. We have to, continue to work very closely on that. The Fed Reserve, they're going to take their action. I can't really comment on that, but we have to make sure that in the short term we do everything we can to reduce those prices, but also long term that it doesn't happen again. A lot of what we're seeing with inflation is due to the pandemic. Obviously, what we're seeing with Putin and what he's doing with Ukraine, but we also have to think long term. How do we prepare the country that we don't go through this again?
Secretary Walsh, I've only got a few more minutes with you because I know you've got to do a range of interviews. You're a busy man this morning, so I'll whip through a couple of other issues. There is a labour contract covering about 22,000 West Coast dock workers at sites including LA and Long Beach ports. That expires on July 1st. I know you're aware of that. I want you to help me understand what's the difference between those unions, those individuals behind those groups that represent them, using their leverage to secure better terms and exploiting the country's dependence on those ports. What's the difference?
I don't think they'll do that. I mean, I was out in Seattle and Tacoma, in Portland last week, specifically to talk to the company and companies about the negotiation a little bit, about how they feel about it in the unions, and express to both sides the importance of what we've gone through as a nation over the last 18 months with supply chain and challenges and still having ships out in the ocean. They all understand the importance of that. And I think I don't see either side exploiting the situation we're living in for better wages. The contract will begin negotiations some point in the next month or so. I believe that's when it'll start. They have to do some notification piece, but I'm going to monitor the situation very closely. Obviously, I want to make sure that we don't stop our ports. I mean, the last thing we need in this country right now, or in this world, quite honestly, is shutting down other supply chain and creating other supply chain issues.
Are you going to step in?
If I need to, I will. I sit to both sides. I mean, I don't think I have to step in at this point.
Sure.
If I did, I'd be having a very different conversation with you. But I think, I feel good where the conversation is with the sides right now. I think that they all understand the magnitude of this particular moment. This is unlike any other moment they've ever had when it comes to negotiations. Still coming out of a pandemic and, moving forward, all these issues around this. So I think they acknowledge very seriously the situation this country is in, and quite honestly, our supply chain is in.
You've been to those ports, you travel a lot. I believe it's 60 cities in 30 states during your first year. You know where I'm going with this. You've also been really criticised because you've spent 162 days in Boston out of your first 284 days in office. Secretary Walsh, this comes up often when you and I talk. It keeps coming up. People keep talking to me about it.
Yeah.
Why is that? What's in Boston?
I think it's a ridiculous argument and a ridiculous point that's being made. In the very beginning of me being Secretary of Labor, we at the Department of Labor, where I'm standing in front of right now, nobody was in the office. We were shut down because of COVID-19, and I was doing my job. I was traveling around the country. Yeah. Some of those numbers that are reported, I go home every weekend to Boston. I'm going to continue to go home to Boston every weekend because I have a mother that's there and I have a family that's there, and I've made it very clear from the very beginning. So I think when that article was written and that reporter put those facts in, she's incorporating the weekends into that. And if she took those out and actually did an accurate account of what happened, they would tell a very different story.
Well, Secretary Walsh, I've got a mother in London. I've got to be in New York. That's what happens sometimes. People are basically asking why you haven't chosen to live in Washington, D.C.
I do live in Washington. I'm in Washington.
You've got a permanent resident there now. You've got a permanent residence there in D.C. now. Just yes or no?
I'm living out of a hotel.
Okay. Secretary Walsh, we've got to leave it there. Thank you for being with us, sir, as always. From New York City, with your equity market doing okay off the back of a pretty decent payrolls report. And don't ask me, that conversation keeps coming up with Secretary Walsh, and he's a very good man for responding to it. This was the countdown to the open. This is Bloomberg.
the financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on this Friday, April 1st. Here are the top market stories we are following for you at this hour. Power in the payrolls. It is a strong March jobs report. Unemployment comes in below expectations. Wages top expectations. Does it tee us up for a 50 basis point hike from the Federal Reserve in May? Back to inversion. It's a dramatic reaction in the bond market as yields jump across the curve. The move is just a bit more in the short end, and the 2-year yield once again tops the 10-year. And audit access. China is preparing to give U.S. regulators a look at auditing for the companies listed in New York in a rare concession. ADRs of Alibaba, Baidu, and Didi jump. From New York, I'm Kaylee Lyons with Guy Johnson in London. Alex Steele is off today. Welcome to Bloomberg Markets. Guy, it's Friday. It's jobs day. First day of the second quarter. Also April Fool's Day. That jobs report, though, no joke.
Absolutely. We're just getting some more data as well. The U.S. March ISM Manufacturing Index coming in lowest in September 2020. You take a look at the employment index within that, though, rising to 56.3 from 52.9. That basically concurs with what we just got from the payroll report, Kaylee. It was a strong number. It was a consistently strong number. The prior number was revised higher. This is a labor market that remains hot. Some would say white hot right now. And it's going to be interesting to see whether or not this nails down 1 or 2 or 3 50 basis point hikes. I think it's 2 nailed down, it seems, certainly judging by the market action today, and we get an inversion. Or is it a little bit more than that? Anyway, we just heard from the Labour Secretary. John was talking to him, Marty Walsh, speaking on the payroll number to get his take on what is going on here. We're joined now by Mike McKee, Bloomberg's international economics and policy correspondent. Mike, how would you characterize today's number? It looked pretty good to me. I'm looking at the ISM number as well. It looks pretty good, certainly the headline number on employment. This is a hot labor market.
Absolutely. It probably would have helped economists get even closer to the number if they had seen this ISM report, because the employment number jumped significantly to 56.3 from 52.9. But just a quirk of the calendar, came out after the payrolls report. But the payrolls report, very strong, shows the labor market is strong. The problem, Guy, is that wages being demanded by workers to come back, and a lot of workers did come back, are still pushing the average hourly earnings number up. And that's going to be a concern for the Fed. They want to see that start to fall back. We did see in the ISM number a little bit of softening, not just in the headline number, but in new orders as inventories rise. So we'll have to see what happens. We saw the PMIs in Europe all fall, still expanding, but all fall from their highs in the last month as the war started. And that may have an impact on the U.S. Maybe we see the manufacturing sector slowing a little bit, and that'll take a little wage pressure off.
Mike, John Farrow on the Open was just talking to someone from PIMCO who said maybe the Fed even needs to move 100 basis points. Does data like this, even if it cements 50, indicate that maybe the Fed could move more?
No, they wouldn't do something like that. I think people are anxious to get started on what the Fed is going to do, because the forecast is we're going to go up 2.5 percentage points this year and another 3 or 4 times next year. So we end up over 3%, might as well get going, I guess, is the feeling. But the Fed wants to make sure that as they feel their way along, and you get numbers like this, is this an outlier, the PMI, that it falls? Or does that trend continue if the economy is going to slow a little bit? They want to make sure that they don't go too far too fast, because monetary policy works with a lag, wouldn't hit the economy for about a year. So I wouldn't expect anything like that 100.
Okay, so that brings us to the question of, is this as good as it gets for the U.S. economy right now?
You know, you really don't know, but I would say we're probably pretty close, because there are a couple of things that are going to start happening. People starting to run out of their stimulus money. The consumer starts to pull back a little bit. Gasoline prices, high gas and food prices, do some demand destruction, and inventories are rising, it shows in this report. So companies may need to cut back a little bit on production. So this could be a high watermark. The problem was we're still dealing with the legacy of the pandemic, and some of the numbers that came out then. So we'll still get some distortions. It'll be a little hard to read, but we could see maybe a bit of a downhill trend. Whether it goes all the way down into recession, still a very open question.
And Mike, little correction for me. It was Mike Collins of PGIM, not PIMCO, who was calling for that 100 basis points. Also within the data, we saw a pretty sizable revision as well upward for the month of February. What would give us an indication on whether or not we're going to see an upward revision for this month as well, considering, yes, 431,000, nothing to sneeze at, but it did come in just a little bit light of what economists were expecting?
You never know, but the trend has been towards a revision higher. You have to go back to July of last year to see a revision lower. So I would expect that we get some additional hiring from these last 2 months put into the number when we get the number for April sometime on May 6th. So yeah, it does look like we're undercounting a little bit in the beginning of the month.
All right, Bloomberg's Mike McKee down in Washington, D.C. for us. Thank you so much. Now let's get more insight into those jobs numbers. We're joined now by Aditya Bhav, Bank of America Securities global economist. So Aditya, your take on the numbers we saw today.
I think this is another jobs report that checks all the boxes and confirms our view that the labor market is white hot. So you can start with the establishment survey. 500 is the new 200, and net of revisions, we actually did add 500,000 to non-farm payrolls. And as you said, wages were also very strong. Look at the household report. That was even stronger. The unemployment rate fell by 0.2 despite a 1/10 increase in labor force participation, which is quite remarkable. And something that doesn't get talked about very often is the fact that participation across the economy is actually slightly overshooting where it would be given long-term demographic trends. So we do have some ways to go to catch up on prime age labor force participation, but if you look at overall participation, that's looking very strong as well, which suggests that some of the distortions that we saw during the pandemic, retirements, people leaving the labor force because of caretaking responsibilities, discouraged workers, all of that has normalized of late, and that's very encouraging.
Aditya, if you had the inflation data out of the United States, if you had the labor market data out of the United States, but you didn't know where Fed funds were, where would you think they should be?
We've been of the view that the Fed has been behind the curve. We thought they should have started hiking latest in January of this year, possibly last year, last winter, last fall. So we certainly think they're behind the curve, and we think they're going to make a pretty aggressive attempt to catch up to the curve.
How far behind the curve are they? Where do you think rates should be right now?
They're probably about 100 basis points behind the curve. I would say that. We should be a lot closer to neutral right now. And one way to think about that is, they've talked about the two pillars of their new policy framework, flexible average inflation targeting. Well, if you look at inflation with a 5-year look-back period, we're still running over 2% 5-year annualized, which means that they don't need to worry about making up for previous undershoots anymore. If you look at a broad and inclusive labor market recovery, that's been achieved as well. You can look at many cuts of disadvantaged groups in the labor market, and they're all doing much better than they were when the Fed started hiking in 2015.
All right, well, the Fed has started hiking now, Aditya. Since you think they're behind the curve, you obviously are assuming they will be pretty aggressive. I'm wondering what that means for unemployment. We got 3.6 today. You expect the rate could fall as low as 3.1% this year. Can the Fed get to where they need to be without raising the unemployment rate beyond 3.5%? Because that's what they set out through 2023.
I think that's a great question, and that is the big question for the Fed to answer. I mean, they're essentially asking, can the Fed engineer a soft landing? And as Powell admits, there have been cases of soft landings. I would say 2019 is probably a pretty good example because, yes, we went into recession, but that was because of the pandemic. It had nothing to do with Fed policy. But it's generally difficult. We know of the SAM rule, which says that when the unemployment rate rises 50 basis points, it usually rises, or it always rises much more than that, and we go into recession. So our view is that for this year, the labor market remains white hot. Gus took the words out of my mouth, Guy did. And next year, though, we cool off a little bit, and that could lead to a bit of an increase in the unemployment rate.
Let's talk a little bit about where inflation is going to be relative to rates going forward? Because this is one of the things, Aditya, that the market is really challenged with right now. Real rates are incredibly negative. Do you think they are going to remain negative? Do you think we get to a point where they could be positive, i.e. we see inflation starting to come down, but the Fed continuing to hike?
Right. So I'm not sure whether you're asking about the real policy rate or the 10-year real rate. But in terms of the real policy rate, I would say that the Fed probably gets to a point where it's a little bit positive. And this is one thing that we need to keep in mind when we think about how much the Fed hikes. It's really the real rate that matters for real economic activity. So while the Fed is expected to hike much more aggressively than it did in the previous cycle, the peak in the real rate will probably be quite similar to where it was in the previous cycle, which is about 70 basis points.
Well, let's talk more about that economic activity, Aditya. Obviously, mortgage rates have already started to climb. We're at 4.78 or so percent, I believe the latest data showed. You also, in consumer spending data yesterday, real spending adjusted for inflation, missed expectations, down 0.4%. Are we already starting to see the signs of demand destruction?
There's going to be a little bit of demand destruction from inflation. Two things that I found quite encouraging about the consumer spending report was, this was coming off of a big upward revision to January. So the level of spending wasn't that weak. Services actually looked pretty okay. So the demand destruction was in durables and in non-durables, where we've seen the big price increases, but we haven't seen a bleed through yet to services demand, which is where we think there is considerable room for upside given reopening over the next several months. And then the last thing I think that keeps us relatively hopeful about the consumer is the fact that the savings rate actually has dropped below pre-pandemic trends, which can be viewed as bad news in the sense that consumers are dipping into their excess savings. But I would say that it can also be seen as good news because it suggests that the people that need to dip into their savings actually have the savings to dip into. So there's been a lot of concern about lower income households. How much of these excess savings, $2 trillion plus, do they actually have? And a lower savings rate suggests that they actually had a good amount of excess savings and now they're dipping into it, which I think is relatively encouraging for the consumer outlook.
Aditya, if the Fed's behind the curve and significantly behind the curve and should have acted earlier, what do you think about the ECB right now? 7.5% the print on inflation. The ECB doesn't have the same labor market problem that the Fed does, but nevertheless, it has a significant energy problem, which is hitting the headline number pretty hard. What do you think of today's number in relation to where policy is? Let me ask you the same question. Where should the ECB policy be right now, given the data we're seeing?
So on the ECB, it's a little more tricky. I think the case to get back to zero is much clearer because there are downside effects from negative rates, which they could take away by getting back to zero. But starting a real hiking cycle, getting beyond zero, means thinking about the balance between the growth shock from the Russia-Ukraine conflict and the inflation shock. So they're more focused on headline inflation, so they won't brush aside the energy and food price increases to the extent that the Fed perhaps will. But that being said, I think there's a difference between what's happening in Europe, where there's a risk of actual cuts to quantities of energy and food available, compared to what's happening in the US, where it's really a matter of higher prices affecting real spending power. So the potential growth hit to Europe is much larger. We've revised down our growth forecasts for Europe a lot more, and we still think they'll avoid recession, but the risks are much larger in Europe, so the risks of over-tightening are also much more significant.
That's Europe and the U.S. What about the U.K., Aditya, where energy bills as of today are going to be a lot higher and that cost of living squeeze is getting worse?
Right. So the Bank of England has taken a very different approach. I would say diametrically opposite to the Fed, where they've said we're going to hike early and hopefully that means we don't have to hike as much, compared to the Fed, which said we're going to hike late and then potentially hike a lot more. So the issue in the UK is that they're facing a double shock, now a triple shock, right? So it wasn't just the pandemic, it was also Brexit. And now, of course, the knock-on effects from the Russia-Ukraine conflict. So there is a risk there that the neutral rate has fallen quite significantly, which could curtail their capacity to hike.
It's amazing the different approaches that are being taken here. We'll ultimately see which one might work out. Clearly, everybody's starting from slightly different points as well. Aditya, thank you very much indeed. Really appreciate the time today. Aditya Bave, Bank of America Securities Global Economist. Kaylee?
All right, Guy, well, we're going to move the conversation from the U.S., the U.K., and Europe over to China because Beijing says it's prepared to make a very rare concession in a long-running dispute over Chinese companies listed in the U.S. You're seeing a lot of those ADRs popping today. The Nasdaq Golden China Dragon Index up 7.4%. We'll have the details next. This is Bloomberg. It's a dispute between the U.S. and China that's been going on for decades. Now, China is prepared to give U.S. regulators what they want: full access to audits of most Chinese companies listed in New York. Damian Sassower, Chief Emerging Markets Credit Strategist for Bloomberg Intelligence, joining us now to help explain. So, Damian, essentially the SEC wants access to these audits, that these companies may get delisted if China does not comply. China was talking about forcing companies to delist months ago. It's a saga that started with Didi, and yet now they're willing to cooperate so companies don't get delisted. Can you just give us your take on this?
Within reason, right? I mean, certainly they're not going to have state-owned enterprises, listed in the U.S. and subject to the same rules by the PCAOB that, the CSRC demands. And certainly, I think that's going to apply to a lot of consumer-sensitive firms. So it's anyone's guess. I imagine that's going to include Alibaba and perhaps Didi and JD and many of the others, right? I mean, so for me, yes, they might be easing on the regulations, but it depends. It depends which category they fall into, in my opinion, Kaylee.
So if they have data, consumer data that the Chinese authorities don't want accessible in the United States, they are ultimately going to have to still delist. Is that the direction of travel here, Damien?
If they don't want to comply. So yeah, I do believe that. I mean, again, Guy, you know, I'm a fixed income guy. I can't really speak to equities and some of the demands that are going to be placed on them by the auditors and what have you. But I'm going to try. Yeah, no, so I mean, exactly right. I mean, look, let's be clear though. I mean, the real issue in China really isn't the delistings here in the U.S. It's upfront, in your face. It's $92 billion of foreign denominated debt that is coming due in the property sector. We know they're feeling the pain. If you look at the PMI data guide just this week, the economy has slipped back into contraction. So things are tough on the ground in China.
Can I just say, Damien just did a mid-answer pivot there back to the credit markets.
Did I?
Away from the equity
markets. Was that a pivot? I just thought I shuffled a little bit on you. Yeah, maybe a little pivot. But I mean, look.
Nice sidestep.
At least I didn't go to Russia, right? So, I mean, I'm happy to stick in the Far East.
Oh, yeah?
Well, no, but let's bridge that gap, Damien, on the subject. We've been so focused on Russia and the companies, their ability to pay off their debt given sanctions, that I feel like we've kind of cast aside the idea of China and possible defaults in the property sector. I mean, where do you think it's going to all come down on this?
Well, it's interesting. With the property sector in China, they had up until the 31st of March to file, or else their shares are going to be suspended on the Hong Kong Stock Exchange. Many of the large property issues did not file in time. So yes, their shares are going to be suspended. This has happened before. I mean, this happened with Evergrande. This happened, you know, with Huarong, et cetera. So this is nothing new. But, you know, we're going to need to see transparency from some of these property sector issuers in China in order to feel a little bit more comfortable on where the economy is heading in China. But shifting to Russia, yes.
Another pivot.
Eurochem, Russian Railways, Severstal, I forget the fourth, Chalpipe, all four, their grace periods expired, all four technically in default. A credit event has happened. Creditors have not received their funds. Granted, it wasn't due, again, to the capacity or willingness to pay on the part of these Russian corporates. It was because Citigroup, or in some cases Deutsche Bank, held up the payment, and they've suspended payment, and it's still suspended as we talk here today.
Damien, what do you make of me being a gas buyer, transferring my euros into a Gazprom bank accounts, that money then being turned into rubles, and those rubles being used to buy gas? Does that sound like a good plan? Because that's the plan we're now working with. And does that sound like a plan that kind of is sustainable and maybe doesn't get around sanctions, does get around? What is your take on this?
You've explained it so well. It's so vivid and clear what Russia's trying to accomplish here, Guy. I mean, but no, I mean, truthfully, we've talked about this in the past, you and I offline, Guy. This comes down to where does the onus fall in terms of who's going to hedge the currency risk around these contracts. These are long-term gas supply contracts, right? So if the onus, which has historically fallen on Russia or on Gazprom to hedge its euro and dollar exposure, I think what Putin is trying or was trying to do is try to put that onus back on the buyers of Russian gas, right? Now, you know, European gas companies are not having any of that. And so at this point, it seems to me that what Putin's suggesting will still place the onus of the hedges on Russia. So that hasn't shifted yet. That's the real risk here, because there's no forward market. There's no way to trade dollar ruble. I don't care if you see 82 or 83 on your screen. That is not reflective of the clearing price in dollar ruble or in euro ruble, whatever currency cross you want to look at. And so the forward markets off the back of that are very illiquid and very volatile, and certainly you can't hedge your currency risk off the back of it.
All right, Damien, so we've discussed China, we've discussed Russia. What's the bleed through from either into the broader emerging market complex?
Yeah.
Is there a real contagion risk here?
Yeah, there is. I mean, this is the real question. This is what I've really been looking at. I mean, Kelly, you hit the nail on the head. So for me, look, I mean, 80% of EM economies going into the crisis had food price inflation of 5%. If we look back to the 70s, that was an oil supply shock. There was no food price shock there. This time around, things are very different. So those low-income economies, those who live out along the frontier in emerging markets, are really going to feel the pain this time around. And let me give you this one. If you look at the total value of foreign debt relative to exports for the emerging market complex, 60% of them, maybe 75% of them, it's doubled, meaning they have so much more foreign debt outstanding relative to their export revenues. It's going to be very, very difficult for them in this environment now, with rates going up and with conditions tightening, for them to pay back their foreign creditors. Many of those really low-income economies, they applied to the IMF. They went to the Debt Service Suspension Initiative. That expired last year, so they're really in trouble. My guess is as good as yours. We could be seeing a bit of a run there as well.
Damien Sasser is definitely a guy that can hit a golf ball and it can go round a corner. I think he can change direction pretty well.
You played with me, obviously, Guy, you know.
I've heard. Damien Sasser, Chief Emerging Market Credit Strategist for Bloomberg Intelligence. Thank you very much indeed. This is Bloomberg.
Jobs Day in America, the report comes in strong. Unemployment lower than expected, wages higher than expected, cementing expectations for a 50 basis point hike from the Federal Reserve in May. As for the read-through into asset classes, you are seeing stocks right around session lows. The S&P now down about 0.1%. A little bit of outperformance for Chinese ADRs for reasons we were just talking to Damian Sassower about it. But the big reaction is in the curve. The 2-year yield up 10 basis points. Once again, inversion on 2/10 as we read through the data here in the U.S. But coming up, we'll talk about the data in Europe. Inflation in the euro area rising to an all-time high of 7.5%. What does that mean for the ECB? We'll talk with the governor of the Dutch central bank, Klaas Knot. This is Bloomberg.
About that all day yesterday.
We're about an hour into the U.S. trading session. Bloomberg's Abigail Doolittle is tracking the moves. All right, Abigail, the message from the jobs report seems to be you definitely don't want to be holding bonds, but also you might not want to be buying stocks either.
True. Kind of a mixed day here, and we're taking a look at it through the world of ETFs. So to Kaylee's point on the S&P 500, down ever so slightly. This is the SPY, down about 0.1%. Now, it had been higher earlier and on that solid jobs report. Right now, down. You have to remember we're coming off of that monster quarter of big moves. So probably some repositioning consolidation here too. But relative to bonds, here you go. TLT down 1.2% to Kaylee's point. This, of course, as yields are simply spiking higher. That jobs report giving the green light to the Fed as though they needed it, but they're giving them that green light that hike away, that the economy right now is strong enough. Now, energy down a little bit, down 0.2%. The USO, that oil ETF, United States Oil Fund. And then the real outperformer here clearly is the China Tech KWEB ETF, up almost 8%. This, of course, as China says that they are weighing the possibility of giving U.S. Investors the ability to audit their companies. That would, of course, provide more transparency and take away the issue that some have called the uninvestability of some of the China tech names. We'll be following that story closely, of course, because it could be a big one, given the fact that last year that area down more than 75%. As for this past week, there's been a lot of optimism for actually all asset classes here. Well, at least stocks, the SPY, $8.6 billion in inflows. That's the best so far this year. The same with QQQ, the best, $4.2 billion. But bonds are not out of it. This is the Vanguard Bond Fund, $2.5 billion flowed in. And of course, that long-term downtrend that shows in yield shows the bond, the great bull bond market still in place. So perhaps with what investors are looking at, emerging markets not doing so badly either. And then finally, let's take a look at our last board. And we are going to see that Europe has been a place where investors are fleeing, most since going back to the early pandemic days of March 2020. These are the monthly flows for a European ETF, and the month of March, you can see, really pretty brutal. And in contrast to January and February, it's the exact opposite of what we saw in U.S. So perhaps some people here, Guy, some investors seeing U.S. equities and assets as a little bit more of a haven than European.
Geography definitely matters right now. Abigail, that is certainly true and has been very true since the war started. Abigail, thank you very much indeed. Abigail, there are work trips and there are work trips. It's time now for a Bloomberg exclusive. We're going to head to Lake Como, to Chinobio. The Ambrosetti Forum is taking place at Villa d'Este, which is, I have to say, one of the most fantastic hotels out there. Bloomberg's Francine Lacqua, as ever, managed to secure a place at the table. She is joined now on a day where we see inflation in the Eurozone, Fran, at 7.5%. You're joined by Klaas Knot, the central bank governor of the Netherlands.
Yeah, it is. You're right, Guy. It is a pretty good work trip. But I have to say it's freezing, and we're talking real stuff. We're talking inflation and monetary policy, and I could not be more delighted to be joined by the governor, Mr. Knot. Thanks so much for joining us. There's so much talk, of course, about inflation today. We had that print that was higher than expected. Inflation seems to be creeping up and up and up, but we heard earlier on this week by the ECB president that monetary policy should still be gradual. Is this a mistake?
No, of course not. I mean, inflation comes up, but of course, I mean, today's inflation in some ways is water under the bridge, right? I mean, this is all energy price inflation. It's coming from outside the monetary union. And our main task is to make sure that this temporary inflation doesn't become entrenched into permanent inflation. For that, we closely watch the medium-term inflation outlook, what it will do, let's say, 2 years from now. And there are sufficient indications that inflation is still to converge back to our 2% target. And as long as that is the case, yes, we can afford to be gradual.
What does it mean to, if inflation keeps on getting higher, and if the supply shocks or energy, if something in Ukraine gets worse, what does it mean in terms of your forecast, and what does it mean for QE?
Well, we've already gone through a series of negative supply shocks. So in the scenario you sketch, it's basically more of the same. It would mean that the dent to growth would be even more pronounced than was already in our March projection. But at the same time, it would also mean even higher inflation for an even longer period of time. So if anything, then we should look for the most ambitious way to normalize monetary policy in a scenario like that.
Ambitious how?
Well, within, for instance, the parameters that we've set ourselves in March, that means that we will have to wind down the APP as quickly as possible. Mm-hmm. We said within Q3, well, that would imply in the beginning of Q3 rather than the end of Q3. And then after the summer break, I think all options would be on the table and would have to be on the table.
So in what scenario do you see that unwinding come quicker than Q3?
Well, that would need a real change in the inflation outlook and the medium-term outlook, for which I don't see any convincing evidence yet. That would require a major shift, for instance, in the wage-setting process. We are perhaps beginning to see the first sort of signs of, let's say, the waking up of the Phillips curve that has been hibernating for quite some time in countries like mine, that are at the forefront of tight labor markets. If we saw a dramatic sort of increase in wages, that could be one scenario. But I'm still very much thinking along the lines that Q3 is fine, probably the beginning of Q3, not the end of the Q3, and then we can keep the gradual posture as we decided in March.
If there's an oil embargo, if something happens on either side and there's no more oil and gas coming and flowing between Russia and Europe, would that be a scenario?
That would be a scenario that I would call more of the same. It would mean a bigger dent to growth, but also higher inflation coming from the energy side. And what we, of course, have to watch is the extent to which that higher energy inflation would be filtering through to other to other inflation of goods and services as well. And the one thing, of course, that is a little bit worrisome is that in the slipstream of headline inflation, core inflation and measures of underlying inflation are also creeping up. And that is a thing to follow.
So there could be much more fiscal spending to deal with the refugee crisis.
Which would be inflationary.
So that would be inflationary. So is the refugee crisis when, we can also find jobs for a lot of the people fleeing Ukraine, would that be inflationary and push up wage prices?
Well, there are a lot of factors going on at this moment, and just to pick out one, I don't think does full justice to the sort of multi-pronged impact that the conflict on Ukraine is going to have. The direct impact will be distortive and will be negative on growth. But then to some extent it will be cushioned by fiscal policy, it will be cushioned by additional spending on defense, on refugees, on having to move to renewable energy, on compensation of our citizens for the loss in purchasing power. And it will depend on the balance of all these factors how big the impact on growth will be.
Is it possible to avoid a recession if there's an oil embargo?
Well, I'm not talking about a recession. I would at most be talking about slowflation, given that the starting point, we should not forget, with less than 2 months ago, we were looking into a growth number for 22, 4+. Okay, now it's going to take a dent, and maybe the impact will be larger even than the impact that we already had in our projections in March. But then there is still some way to go before we would be in a situation of stagnation, let alone recession.
So why are you so confident that inflation, gets under control almost by itself?
Because of the nature of the inflationary shock, which is a negative supply shock. It's driven by energy. Again, we carefully watch whether there are second round effects. We carefully watch whether it is filtering through to other products and services as well. Wages is a thing to monitor. And at this moment, we don't see a very strong effect that makes us question the inflation outlook over the medium term. And by the way, market indicators of medium-term inflation also seem to confirm that view. Our own projections are not our only information feed. We look at all information from other sources as well.
I just wonder whether, shock after shock after shock in terms of supply shock, at some point there's a feedback loop where actually,
well, it increases the likelihood, of course, that there will be second round effects through wages at some point. So that is, the shock in and of itself are temporary, but the likelihood of being translated into more permanent inflation is becoming larger with every shock and becoming more uncomfortable.
So what are the chances of an interest rate increase this year?
Well, as I said, I believe we should be out of asset purchases before the summer. And then when we come back from our summer break, I don't think we are currently in the position to exclude any possible scenario with respect to liftoff.
Yeah.
So yes, that could be September, October, December, should all be possible.
And what's the effect of an interest rate increase? I mean, there must be a big difference if you do it sub-zero or when you're above zero.
I don't think that is necessarily the case. I mean, when you go sub-zero, it is uncharted territory. We're on the way back. It's all charted territory. So in the sense that there is no reason to view it any differently than an interest rate increase above zero.
What's your biggest concern right now of that could lead to a policy mistake in how you look at GDP, how you look at these price shocks, food, also security?
The biggest concern is probably an escalation of the conflict into domains that we haven't seen. It's already a humanitarian tragedy of unprecedented proportions. But if the war were to broaden beyond Ukraine into, for instance, NATO territory, that would make it very, very difficult to gauge also the economic impact.
So what would that mean for a central bank? Actually, how do you
Well,
deal
I
with
don't want to
something like that?
speculate about that. I mean, there are always scenarios thinkable. We will, at that point in time, formulate a policy response, but I don't think you can formulate that already in advance.
I know central bankers absolutely hate to talk about currencies, but given the volatility that we've seen, does it make your job harder?
You mean the volatility in the exchange rate?
Yes, in the exchange rate.
Well, yes, to some extent it does, although I would also say that the exchange has been remarkably stable. I mean, it could have been far worse, but what is an additional concern for me is also that most energy prices are invoiced in US dollars. So if the euro were to weaken too much, that would even aggravate our problem with high energy prices and the loss of purchasing power that our citizens suffer from.
What would you ask governments today in Europe to do in terms of fiscal policy, maybe to give a little bit of a helping hand to monetary policy?
Well, fiscal policy, I think, is doing the right thing at this moment. It is trying to cushion the impact of the shock through the 4 channels that I just sketched. So in that sense, monetary policy needs to be focused on inflation, and it is fiscal policy that needs to take responsibility for stabilization.
Last note, thank you so much for joining us. Of course, that was an exclusive conversation, an extremely important voice when it comes to inflation and also monetary policy. Kaylee, back to you in New York.
All right, Francine Lockwell with that great interview. Thank you so much from a beautiful Lake Como. And of course, we'll have more from the Ambrosetti Forum in Cernobbio, Italy. Next hour, we'll be talking to Mairead McGuinness, European Commissioner for Financial Stability. But coming up, we'll turn back to wages, which Francine and Mr. Knott were just discussing. It's an issue here in the U.S. with the jobs report showing wages rose by the most in almost 2 years. According to our next guest, that could eat into corporate profits. We'll talk about it with Chief Equity Strategist and CIO at Morgan Stanley, Mike Wilson. This is Bloomberg.